This learning objective will explain the three principal types of business activity. All businesses are involved in three types of activity: financing, investing, and operating. The accounting information system keeps track of the results of each of these activities. Let's discuss each type of business activity in detail. There are two primary sources of outside funds for corporations. A company can borrow money or it can issue or sell shares of stock in exchange for cash. A company can borrow money, and we refer to this as debt financing. It can obtain a loan from a bank or borrow directly from investors by issuing debt securities called bonds. Persons or entities to whom companies owe money are called creditors. Amounts owed to creditors in the form of debt and obligations are called liabilities. Specific names are given to different types of liabilities depending on their source. Companies may have a note payable to a bank for the money borrowed to purchase equipment. Debt securities sold to investors that must be repaid at a particular date are called bonds payable. The other sources of financing for corporations are issuing or selling shares of stock in exchange for cash. We refer to this as equity financing. Corporations can obtain funds by selling shares of stock to investors. Common stock is the term used to describe the total amount paid in by stockholders for the shares they purchase. Many corporations make payments to shareholders on a regular basis as long as there is sufficient cash. These cash payments to the stockholders are called dividends. Once the company has raised cash through financing activities, it uses that cash in investing activities, which involves the purchase of resources a company needs in order to operate. A company purchases many resources such as computers, equipment, furniture, and buildings. Resources owned by a business are called assets. Different types of assets are given different names. Cash is one of the most important assets owned by a business. If a company has excess cash, that is, it does not need it for a while, it might choose to invest in securities, stocks and bonds of other corporations. Investments are another example of an investing activity. Once a business has the assets it needs to get started, it begins operations. Many companies sell products. For example, Columbia Sportswear sells a variety of products such as winter coats, ski pants, and boots. We call amounts earned on the sale of these products revenue. Revenue results from the sale of goods or the performance of services. Revenue arises from different sources and are identified by various names depending upon the nature of the business. The company purchases long-term assets through the investing activities which we just discussed. Other assets with shorter lives result from operating activities. For example, supplies are assets used in day-to-day operations. Goods available for future sales to customers are assets called inventory. If a company sells goods to a customer and does not receive cash immediately, then that company has the right to expect payment from that customer in the near future. This right to receive money in the future is called an account receivable. Before a company can sell a product, it must either make the product or purchase it. It also incurs costs like salaries, rent, and utilities. All of these costs, referred to as expenses, are necessary to produce and sell the product. Expenses take many forms and are identified by various names. For example, cost of goods sold, selling, marketing, administrative, interest expense, as well as income taxes. Companies may also have liabilities arising from these expenses. For example, it may purchase goods on credit from suppliers. These obligations to pay for these goods are called accounts payable. Companies may have interest payable on the amounts owed to the bank. It may also have wages payable to its employees and sales tax, property tax, and income tax payable to the government. Companies compare the revenue of a period with the expenses of that period to determine whether it earned a profit. When revenue exceeds expenses, net income results. When expenses exceed revenue, a net loss results. For this exercise, you will indicate whether or not the activity is operating, investing, or financing. And the solutions to this exercise will be provided in the next video.